IVM.
Folks, welcome to Paisa Vaisa. I'm your host, Anupam Gupta, P50 on Twitter, and I'm excited. I love these kind of super duper special episodes because A, we've got a mutual fund. We don't usually get mutual funds. We have a returning guest of a guy that I really respect. I've been following his Twitter stream for a long time. Kalpen Parekh of DSP Mutual Fund, and there's one more, okay? And see, we have a very, very, very hot topic, depending on which side of the bucket you're from, the fence that you're from, value investing. Yes, guys, value investing. So, without further ado, let's welcome our guest, Kalpen Parekh, President, DSP Mutual Fund, and Aparna Karnik, Head of Risk and Quantitative Analysis. We are going to talk about DSP Mutual Fund's latest offering, the DSP Value Fund. Kalpen, Aparna, welcome to Paisa Vaisa. Guys, thank you so much for doing this for our listeners.
Anupam, thank you for inviting me, and to all your listeners, happy to be here again. Always enjoy the late evening conversations. Just that this time, in the lockdown, I'm not getting a cup of tea that you otherwise offer me.
I remember the studios. And Aparna, welcome to Paisa Vaisa. First time for you.
Yeah, absolutely. It's a pleasure being here, and it's great to actually have these sort of platforms, and these are some of the things that are new in this lockdown, new ways of sort of reaching out to people, new ways of communicating. So it's great to be here, Anupam.
Good to know that. It's always good to have a mutual fund that wants to personally come and reach out to listeners. So guys, let's start with value investing. Okay, we'll talk about the concept here. We'll start with that, what it means in the classic sense, okay, and where things really stand today. Now, the legendary Professor Aswat Damodaran did this massive 3-post long read on his blog. Okay, 3 entire posts on his blog dedicated to value investment, and a lot has already been written. At a conceptual level, give our listeners some perspective here. What it meant, probably back in the Benjamin Graham days, and where things stand today. Let's start from there.
Aparna, you start.
Yeah, great. So, see, and I'm going to give a slightly different perspective here because, I come with that quantitative lens. So the way, as you rightly said, the Benjamin Graham, etc., way of looking at value essentially was what they termed as intrinsic value, where you are buying something for less than its worth, which is, assessed in a very fundamental way, looking at a lot of measures. Historically, I think they used to look at more of those P, PB, dividend yield, these kind of metrics. So that was the old style of kind of identifying value, basis those the old books. And even I think when Warren Buffett, etc., 40, 50 years ago started their journey, this was the approach that was taken. But over the years, we've seen that value investing has evolved, beyond a point, any investor will call themselves a value investor. So there is no black and white answer about, because value, like beauty, sometimes lies in the eyes of the beholder. But the way we understand the evolution of value, and some of these we have tried to incorporate in the design of the fund, essentially is looking at things like quality at a reasonable price. So that's more towards the line of the quality valued style of investing. And I think that is, used or practiced by a lot of people, including Warren Buffett today, where essentially they're not just looking at cheapness, but they're looking at cash flows, they're looking at longevity of cash flows, they're looking at profitability, and then they are assessing whether the valuations which the companies command, are they commensurate with that or not.
Sure.
Today, to be honest, there is so much more to value investing than even that style of thinking. Today, value investing, even people look at it from a very top-down perspective. Things like special situations. Things like activist-based investing, where you take over the entire company, change the management, and only then you are really able to derive the value out of it. On top of that, you have a whole new line of quant/passive based value investing, where again essentially you build up value portfolios using fundamental metrics like P, PB. You combine it with different styles like size or like quality, and that there is a whole style of value investing which is even at a factor space. So these are the different forms of value investing which are, being practiced in the current environment.
So you've basically come a long way, you're saying. I mean, when you had the Grahams and the buffets, which were more of I think that was post Second World War thing, where there were actually stocks out there which probably traded at a deep value,
exactly.
And you just look at P's and that's it. Whereas today, value investing is now this entire school of thought which has come to mean a lot of other things, right?
Yes. So it has evolved beyond that essentially, because at those 40, 50 years back, markets were not so efficient or crowded. Yeah. Today, to spot those kind of, in today's sort of data-rich, where there's so many market participants, to find value like that, it may not be, as it was 40, 50 years back.
Kalpen?
So my take on this is, there are these investing giants and icons who have done seminal work in this space. And, with all humility, I am no one to try and redefine that or make any changes to that. What we believe and we are trying to do here is to say that value investing is sensible investing and is investing which respects margin of safety. In terms of, two big risks. There are two big risks when we do any equity investing. One is the quality of the business and the risk arising out of poor quality. So how do we solve for that? And there are ways and means through elimination and selection of fundamental matrix. We ensure that we solve for the quality part. Having done that, in periods like today, where interest rates are heading towards zero, quality businesses are also quoting at astronomical valuations. So that creates another type of risk. So while we solve for the quality risk, we create a valuation risk. And, no doubt for the last 7-8 years, not worrying about valuation has not mattered. It has actually helped you and earned more returns. But if one were to say that at some point in time, excessive valuations can also create valuation risk, and that valuation risk can slow down your returns for a fairly long period of time. So how do we solve these two risks together is what we are trying to solve for. So, good businesses at good prices is in a very simple way what you try to do. Yeah, and so that's what is value investing in a very simple way, as I have understood it, or as I would want to understand it.
Fantastic. That's actually going to be my next question, because I have kind of framed this today's episode on a very simple format. We talk about philosophy, process, performance, and then on the other side of the break, we come back and talk about the actual product. So we spoke about philosophy, which is value investing. Let's get into the process, right? Because, our listeners can, of course, download the fund document from your website and get the entire details. But I love the way that you guys go after process, right? Because now we moved into a phase, Kalpen, and both of you all would know this, that the market has evolved over the last 20, 30 years, where 30 years ago, you would probably just take an annual report and then put a bet, use some judgment, and boom, that's it. Today, now the process and the philosophy has become much more important than anything else, right? So let's go into that, the process for the DSP Value Fund. Because now we're talking specifically from an India perspective.
Sure. So, I'll give you at a very structure level what is this all about, and then I'll ask Aparna to deep dive into it further. What we're trying to do here is to say that, we have 100 rupees in a portfolio. Our approach is to, first of all, eliminate brutally. So, eliminate, tell me where will you die so you don't go there, is the thesis that we try to look for when we look at risk management. So what are the fundamental, parameters which typically hurt a business secularly? We eliminate on all those parameters. So whether it is leverage in a business or poor governance, poor capital allocation, very high volatility of the stock price itself. So there are a lot of these standard, parameters we all know about. We use them to eliminate a lot of companies from our universe. So we start with our universe. Our landscape is the Nifty 500. We first eliminate companies. Having done the elimination, what is left is reasonable quality. Now here we apply filters of, dominant quality filters, which we have studied over time, which tend to have source of alpha or source of broadly beating the benchmarks. So these are parameters like consistency of profit growth, parameters like steady ROEs, free cash flows, companies which are paying dividends consistently. So these are very simple parameters again, but simplicity is very difficult to actually always put in a portfolio together because there are a lot of daily noise factors which are vying for our attention. So we switch off. So here is where the process of rules becomes important. So first we eliminate, then we have a bucket of quality, and then we say that having designed this bucket of quality, there are many companies which are very high ROEs, which have promising growth, promising narratives, and hot sectors, but they are also getting overcrowded because a lot of people are chasing them, and they are tending to get valued towards significant extremes to their own sectors, history in India or globally. So we say let's eliminate extreme valuation outliers as well. And then, narrow it down. And we do this at a sector level in context to the quality of the business also. So not just valuations alone, not just statistical cheapness, but a valuation in context to quality. So as a matrix of both. And then we say that, okay, if this builds a portfolio, great. But if it doesn't build a full portfolio, we'll keep some money in cash as well. In markets like today, for example, we may have 15 or 20% in cash also, because most of these companies are still reasonably priced. And the third thing that we are introducing here is that, and this is a very important need from an investor's wallet perspective. Today, we are saying that almost 100% of our income is coming from India as investors, and 100% of our assets are also getting deployed in India. But a lot of our expenses is actually going to companies outside the country, and some of the best businesses are residing outside. They have similar ROEs and quality metrics as Indian companies, but they are still cheaper than ours. Some of them are, half time valued just because India has a significant growth premium and scarcity value. Companies get overheated, and all of this in the long run normalizes. So 1/3 of our portfolio will go into, global companies. And in a few years when markets are extremely stretched and, all companies are not available at reasonable valuations, we don't hesitate in keeping some amount of cash to minimize drawdowns. Once in 5-6 years, drawdowns happen. And when drawdowns happen, it's very difficult for all of us as human beings to stay away from that volatility. And we tend to get out of the train. And then we miss out on our long-term compounding. So we want to minimize. So this, in a way, is a very conservative design we are trying to, put together so that longevity is, we want to buy longevity from our investors and from our underlying portfolio. Rather than very high returns and then very high, drawdowns and again very high returns.
Aparna, your thoughts on what Kalpen said about the process, please.
Yeah. So basically, like Kalpen said, our intention essentially here is that we will respect capital preservation while trying to achieve capital appreciation, and over the long-term journey, give steadier returns to investors, which are on a superior from a risk-adjusted basis. So capital preservation with income plus upside is what we're trying to achieve by this product. And again, one of the most critical principles here is essentially the behavioral aspect. Because fund managers, when they are in the flow, in the noise or the momentum of the market, it becomes very easy to justify valuations looking at forward growth forecasts and to give essentially to give examples which say, okay, this is justifiable because of XYZ reason. The interest rates are low, cash flows are great, there's a technological disruption, and also time immemorial it happens like that. So we have to, through our process, reduce or control some of those kind of tendencies. So that's how we've designed the process. And also sometimes we get into this value traps thing, where somebody says, oh my God, this is so cheap. We have to buy this because it's like, it seems as if it's very difficult humanly again to resist that temptation of the quick buck or the, quick upside. So managing the human temptations and human emotions is actually where the entire process and objectivity come into the picture. So that's how we've designed this process. So how we do this is we start with a 500 stock universe, because value could be anywhere. It could be in the large caps, mid caps, small caps, and it's we don't want to put artificial constraints or boundaries in terms of where value can be located. So once we do that, first we look at the quality criteria, obviously, because we don't want value traps, we don't want wealth destroyers, we don't want unnecessarily volatility in the portfolios of the investors. So we remove companies which have high leverage, we remove companies where there's a fundamental conflict of interest between management and shareholders. We remove companies where they have shown very suboptimal growth over long periods of time. We remove companies where there's excessive volatility in stock prices. We remove companies, where the accounting and governance filters get breached. We have many, screens and many models in-house which help us to identify these, and many different data sources also. So once we do this very objectively, without, without any human overlay on this process, essentially we eliminate a lot of companies from that 500. And then there's no question of, maybe it's so cheap that it justifies being mediocre, but we are not actually applying that. We are saying that if it's a mediocre company, it doesn't matter how cheap it is, it's not going to be a part of this portfolio. So we're not saying that that approach is bad or wrong, but we are just trying to define what is the philosophy and process which we are going to follow in this fund. So there's no right or wrong. Any of them, if done correctly or executed well, can make money. It's not that you can't make money by taking tactical calls on cheap companies or whatever, but that's not what we're trying to do in this fund, because of the overarching principle that we have outlined in terms of capital preservation, etc., that we spoke about. Then after looking at it, then we look at valuation very objectively, and again here we are not trying to do intrinsic valuation using DCF and all that. What we are essentially looking at is a lot of long-term data points, which essentially we are saying that over long cycles, over long periods of time, the capital markets are reasonably efficient in pricing securities. And when you look at long data points, then you are able to identify excesses when they happen, because you are essentially not blinding yourself to very near term. People tend to forget, and they tend to magnify only whatever has happened in the last nowadays it's becoming even shorter, last few years, and they tend to forget everything that happened before that. So by having long-term data points as benchmarks, it helps to weed out and identify those excesses. So what we do is we look at metrics like price to book relative to profitability, and with sectoral adjustments. And I think some of these things even Damodaran, etc., talked about, that some sectors have intangible versus tangible assets, and then some industries are declining versus growing. So those type of premium and discounts are very steady and persistent, and so we measure and bake these into our estimates as well. And then we assess where the valuations is vis-a-vis where we believe it should be, and making some little bit of leeway for the fact that it's a very high quality company to have screened through all this process. We know where we have a range of valuation essentially. We measure it using price to book because it's less affected by cyclicality, and despite its lacunae, it's still, we believe, a good metric to look at. And then we weed out all those companies where they're crossing that particular threshold very objectively. So we'll not try to justify, no, but this is growing very fast, or no, but this technology is going to disrupt. And then whatever is left, essentially that becomes the universe to build the portfolio. And again, we wanted to be respecting risk constraints. So we have a lot of concentration on single stock, active risk, active weight, sector, liquidity. All these are baked in, and then we, at a bottom-up stock-by-stock basis, build the portfolio. And as Kalpen said, if we are not able to build the portfolio using this process, automatically the balancing becomes cash. Yeah. So it's very because what happens, many times when you look at valuations at a market level, like a lot of people ask us that a market is very expensive, but market is just a part of the, it's like a rules-based, composite, which again is biased towards sectors and stocks, so it doesn't mean that if the broader market is looking expensive, broader index is looking expensive, that everything is uniformly expensive within, So we are trying to find out those pockets of value, and then they become the portfolio. And many times they will be very different than the index inherently by the process and the design of it.
I like how there is some element of quant also out here. There is some element of subjectivity also out here, and we are dealing with a market where 10 times book for a certain stock might actually be attractive. So okay, we've done philosophy, we've done process. Now let's get to the actual meat. Okay, let's talk about performance. Okay, now your benchmark is a very interesting one. It is the Nifty 500 Value 50 Index. Okay, a very interesting index. I had a look at the fact sheet on the NSE India website. It's got a PE of just 10.85. Okay, and I guess that's like at a massive discount to the Nifty, at least the PE that the NSE publishes. It's got a price to book of just 0.75. Again, totally out of whack because it's saying that it's actually trading at a discount to book. And then the killer, a dividend yield of 6%. And then when I looked at the stocks which are out there, kind of made sense, right? Because all of these watering valuations and the 6% dividend yield is because of PSUs. I would think because one, metals are the largest component, followed by financial services and oil and gas. Between these three sectors, I guess we are talking about 50-60%. Okay, so wo ho gaya. And now performance, right? 10% total return since inception. I guess that's about 7% price and 2% dividend, or roughly round about that. And they've got a base date of 2005. Your thoughts on this, and what's your philosophy on beating this index long term?
Yeah, I'll actually just give our perspective. You see, the truth is that many times when you choose an index, now it's essentially supposed to represent the universe of stocks that you're going to be in and the style. So this is one of the value indices out there. But if you look at all our collateral that we put, our presentations, etc., everywhere we have actually talked about comparisons with the broader NSE 500. Okay, so while and we discussed earlier also that we are really not into buying the cheap stocks, which are essentially where there are the issues that we spoke about. So while that index essentially represents a value style within NSE 500, Nifty 500 universe, which is why it is the benchmark for the portfolio. But essentially, whatever we are doing, we are trying to benchmark ourselves versus the broader Nifty 500 as the we want to beat that. So that's, what we would be benchmarking ourselves against genuinely, rather than this particular index, which is more a representation of the style and the universe. So we would not request you to read too much into the benchmark.
Benchmark.
Yeah. So for us, we are trying to essentially beat the Nifty 500 with lower risk and better downside protection. That is what we are trying to do. And we are really not buying companies just on cheapness in any case. We are looking at quality with reasonable prices as the construct for this fund.
Yeah, and then the performance history also shows. There is a sheet in your presentation. We talk about the value strategy and compares that to the Nifty 500 TRI. Kalpen, your thoughts on this here, because when I looked at the 6% dividend yield, मुझे 2003 का याद आ गया. And believe me, there are a lot of people today think that we are in 2003. Okay, I think, boss, ठीक है, all the best with that. That was a time when at an index level dividend yield was more than fixed deposit. Your thoughts?
So, in a way, when you look at that space of the market, the dividend yields are higher than 10-year government bond yields, no doubt. So they have their own reason to be attractive. Just that, and in fact, today only I have, posted a tweet saying that there are three parts to the market: very cheap market, but discomfort or anxiety on capital allocation on that space. Then something which is priced in between, good businesses. Actually, nothing is very cheap in good businesses today. Good businesses, but at slightly fair value plus prices. And then businesses which have a lot of growth but very much overpriced. We are somewhere in the middle, and that is where our portfolio will be constructed. And the uniqueness that we are offering is blending it with a global slice, which is very meaningful, 1/3 global slice. The second point, the representation. In fact, it will be unfair on our part to say that we have beaten the Nifty 550 benchmark, because that space has actually got decimated in the last 10 years. Whereas we are operating with a far better quality segment. So it's like comparing apples and oranges. But we intend to once we are actually going to write to SEBI to just make modifications in our benchmark as well, to have Nifty 500 as a more representative benchmark of what our strategy is. So that we are comparing apples to apples. And clearly, I think the more important thing to note is whatever is our portfolio return, the India strategy and the global strategy put together. And when we compare that to Nifty 500, it demonstrates similar returns, but with lower volatility. And I think that is what we are trying to offer. See, end of the day, as an investor, when I look at any new product, should I add it in my portfolio or not? What should be my filtering criteria? That for everything else being equal, is it going to, likely to enhance my returns? Or for all else being equal, will I get the same return at lesser volatility? I would like to position this product in the second bucket. So investors who are expecting very high returns, I don't think this is the right product for them. I'll be very honest upfront. This is this is a fund designed for lesser volatility, lower fluctuations. And lastly, what we try to do always is we have ourselves learned that most often backtesting models, have some bit of exuberance in it because it's not in the real world. But we try to solve for that by, testing our data points in a real world by assuming a certain amount of size, certain amount of liquidity constraints. We don't give the highest weight to the best performing stock because we realize that the best stock may be a small stock and maybe a small part of the benchmark. So even our weights would be, constrained along with that so that we are more real. And we have loaded a cost of around 3% on our backtesting. So whatever returns we have posted in our slides are after netting off a 3% cost, whereas the actual cost will be 1.6%, 0.8 and 1.6 direct plan and regular plan for our investors. So we try to be more conservative in our backtesting because we would rather under-promise and deliver rather than, over-promise and still deliver.
And I like the fact that in the presentation you've given, you've on, slide number 19? Yeah, slide number 19. You've actually given scenarios. You've given what happens to the portfolio in taper tantrum, what happens to it during demonetization, and what happened most recently with this COVID-19 that we've had. And the value strategy is actually somewhere probably in the middle of, it's exactly what you were saying. So even though you've backtested it, you've probably taken real life scenarios.
So Anupam, great point. Great point you highlighted. See, what I want to highlight, a lot of investors were coming in new today, and I'll fast track the last 20 years for all of them. Is we've seen in India in the first decade between, let's say, 2000 to 2010 or 2003 to 2008, where Indian markets went up 7 times in 4 years. Small caps went up 15 times in 4 years. We were at a 10p. A 10p market went to 30p. May not happen, again. So the first decade belonged to emerging markets and, India clearly versus the developed world. Keeping that in mind, no one ever thought that one should diversify abroad. And we all said that we should, only put our money in India. India mein itna growth hai to bahar kyun jana chahiye? That was the thesis. But if you take last 10 years now, in the last 10 years, investors have been a bit disappointed. I wish I had put more money in, US stocks or FANG or NASDAQ and stuff like that. So these cycles keep rotating, and honestly, no one has a clue next 10 years what is going to do well. I will not astrologize. All I'm saying is there are good businesses in India. There are good businesses outside the world. Blend it together. When you blend it together, the journey is far more smoother and less volatile versus doing it independently. And that's what we're trying to do.
Lovely. So guys, we're going to take a break out here. We've covered a lot of ground in the first half of this episode. We've spoken about the philosophy, the process, the performance, a lot of stuff. Deep conversations out here. On the other side, now we're going to give you the actual idea, the product. Okay, the product, what it's about, why you should invest, or where this forms part of your asset allocation, your asset allocation strategy. So don't go anywhere, guys. This is a really super duper episode of Paisa Vaisa, the DSP Value Fund special. My guest, Kalpen Parekh, President, and Aparna Karnik, Head of Risk and Quantitative Analysis at DSP Mutual Fund. We'll be right back.
Hello, everybody. Welcome to an awesome, amazing, incredible week on the IVM Podcast Network. If you're not following us on social media, please do. Why aren't you? You should. It's absolutely essential that you do. It's IVM Podcast on Twitter, Facebook, and Instagram. Another fun week in the books last week, and I think you guys should definitely check out some of the shows that we did. So first, let me tell you about Cock and Bull. We did 2 Cock and Bulls on Cyrus Says last week, which is, I don't think we've ever done before. But there was just so much to talk about, and it was fun. The first one was just on Trish, myself, and Cyrus. The second one, we had Abhijit Ganguly on, and that was a great episode. Do check that out. Check out Know Your Kanun as well. It's been a while since I spoke about that show, but Amber's been doing a great job on it. This week he spoke to Naina Sharma, a Canadian lawyer, about the ways that you do business in Canada and the challenges that presents. Definitely very interesting stuff. Do check that out. The guys at Naan Curry are doing some really, really fun stuff. Do check out their latest episode. They talk about roti, the simple bread, but it's got some complications to it. Let them tell you about what they are. Do check that out. Also, do definitely check out the Wire Talks with Siddharth Bhatia. He's been killing it, man. It's just a new show, but what great conversations. This week he had Siddharth Singh on to talk about pollution. do check that out. And you know what, guys? The best news of all, Simplified is back. They've been back for a few weeks and I haven't called them out before, but remember that they're back and do check them out. This week they talk about, does censorship make sense? Knowing the guys, I think I know the answer to that, but you should go check that out. And with that, let's go back to your show.
And welcome back to this really super duper special episode of Paisa Vaisa, the DSP Value Fund special. My guest, Kalpen Parekh, President, DSP Mutual Fund, and Aparna Karnik, Head of Risk and Quantitative Analysis at DSP Mutual Fund. In the first stop, you're talking a lot about the philosophy, the process, the performance of value investing and the new fund that they have. But now they're going to get you exactly what you want to know. Okay. So Kalpen, Aparna, welcome back. Kalpen, I'm going to start with you. Okay. Now you guys have this thing of following trends that are out of fashion. I remember your tweets from a while ago about pharma and how that performed. We all know that there was a point of time where you had stopped the small cap fund from new flows, stuff like that. I missed out there. Anyway, now let's talk about this. Okay, value investing beaten up. This kind of a topic where people don't even want to talk about it. You have legends like Professor Damodaran landing three long posts about how value investing should change from our listeners' perspective. But okay, how should they look at this fund versus competition? Okay, because I guess it's now a fairly crowded space. How should they look at it? How should they look at this fund?
Okay. So Anupam, very fashionably, I can say that we time our products very well because we stopped small caps and, markets fell. We launched healthcare and it went up. But let me say that partly luck has contributed a lot. We launched healthcare almost at a 4-year low to its past history. And even in the next 7-8 months after we raised money, healthcare stocks were actually drifting down. And then COVID happened and, some bit of fundamental changes also happened. So it was a combination of these two forces together. So had COVID not happened, our healthcare fund would have still done well, but not as well as it did. So, we had not budgeted for that. So I would not probably take credit for the fund having done well because of our foresight alone. But we just said that, okay, something which is getting out of fashion has only 3% weight in the overall benchmark today. Whereas, banking and financials and everything were 30% of the benchmark. So uncrowded space, it's always good to be in uncrowded space where competition is less. You're able to build your portfolios and, acquire build your portfolios and then play for the long run. Likewise, value out of fashion. But I will just differentiate here that this is not the classical value which is completely out of fashion, which is PSUs and energy and commodities and stuff like that and metals. You will see a lot of those sectors still not getting represented in this portfolio because those companies or those business models still don't have ROEs which are better than their cost of capital. Their balance sheets are still very stretched. We have to take a view that the cycle will change, growth will come back, metal prices will go up, and if all of that happens, then that space will do very well. But in our world of value investing, we are saying we don't want to get into predictions. We don't want to get into forecasting. So this is a slightly different approach to value investing where we are saying quality remaining intact. What are the businesses which are relatively cheaper and hence, not truly comparable from a cycle low point of view. So I won't say that, we are launching it at a very, very cycle low. Our stocks will still be reasonably valued compared to, past history. So I just want to be honest about it. But where I look at this product in my wallet, in my own portfolio or anyone's portfolio, from a very long-term perspective is sensible rules of investing, talk about good companies, good prices, good diversification, tax efficiency. We are trying to put all of it together in one single fund. So, good India businesses, good global businesses. Typically, when you want to buy international stocks, we offer international funds. But international funds get also taxed as fixed income. So, if you want favorable tax efficiency, then this blend of 65-35 within a single fund brings you a tax efficiency. And then as an investor, you don't have to keep watching both of them separately, keep rebalancing them separately. And that is the beauty of the product. The magic or rather, the benefit statement comes from mixing ideas. And when you mix them, it reduces volatility. I am harping again and again that a product which will have lower volatility than individual constituents is the beauty of the design.
Aparna, I want to ask you this. Okay, Kalpen spoke a lot about lower volatility. Nifty has gone from 7,500 to 13,000. Pata nahi kya ho raha hai. People probably want now higher volatility and higher returns. Give us some perspective on the quant side here. probably your side of the business. How should a listener who's looking at this fund differentiate this from other products, say from a quant fund? I think you guys also have quant funds, and you also look at that business, which is a fairly rigid but a very systematic, rule-driven process, and also matches an element of subjectivity on the value side. How should listeners look at this fund? Your perspective.
Yeah. So, again, it is completely different from the, the quant fund, which is more of a multi-factor, all-weather fund, which tries to essentially buy, good quality stocks, having some respect for it. This is treating valuation far more clinically or objectively. It becomes an elimination parameter, yes, no. So, frankly, if you see the weights commonality of this product with our own other funds and with other, other sort of large funds that are out there, it's barely 10 to 15%. So the portfolios get created very differently. And as again, you're saying that, like market is at 7.5, was at 7.5, today it is at 13,000. So again, getting into that same mode of the index, so there are going to be lots of parts of the index which will not come into the portfolio. So essentially the stocks which would represent the domestic component would not be a very large part of the index at all. However, there would be companies which are reasonably profitable companies and where the valuations are still reasonable looking at long term. So it will not have any of the, glamour stocks or the very, very expensive stocks. None of that will be there in the portfolio. And again, where the quant part comes in is irrespective of market is at 13,000 or market was at 7,000 or market was at 10,000, the framework is going to be the same. Okay, the benchmarks which are based on long 10-15 year history, they're going to be exactly the same. So the model doesn't really differentiate whether market is at 13, market is at whatever level it is at. It will just apply the principles on a stock by stock basis very objectively. If it is within the within the valuation and quality bands, it can come in the portfolio. So what happens is if it is outside, you stay in cash. So the point is that so this fund is likely to at this point of time have some degree of cash exposure apart, and when you look at the when you look at the portfolios itself, when you stay in cash and then you get a good opportunity to deploy, again that time there'll be no fear factor. If the valuation is correct, we can run the numbers, and if then there are certain stocks which were expensive but now are not looking that expensive, so they're coming within it, then you will go and buy those stocks. Then you will not think ki acha market will fall another this and that. So you basically that's where you remove the fear and the you bring in that very objective method to building the portfolios. Therefore sectoral mix will change, names will change. Sometimes you'll have 40 names in the portfolio when you get, sometimes you'll have only 20 names in the portfolio, more maybe a little more concentrated. That's
you have
how
that kind of flexibility.
Yeah.
So I'm actually now going to go a little bit off topic, and I'm going to throw a question to both to both of you. Kalpen, you first, and then Aparna. See, here's the thing. And I get asked this question a lot. It's something that forms a lot of conversations also. So you've got the optical, or rather the price to earning and the price to book of a certain stock. Now, classically, if you look at it, the value of a stock is always the future cash flows discounted back to today, and that's what theory tells us. Does that mean that irrespective of where price to earnings or where price to books are, you will buy the stock today? Because in any case, you will get earnings growth, right? Whether you're buying an NBFC at 10 times book or you're buying an FMCG or whatever it is at 50 times book, ultimately you're going to get that 10-15% earnings growth every year. What are your thoughts on that when you look at it, from any perspective? Because that's one thing that always comes in the middle of us with our biases, right? Are ye stock to 100 ka 5,000 or 500 ho gaya? Whereas reality and theory tells you that irrespective of PE multiples and price to book multiples or whatever it is, if the stock price today is supposed to represent the discounted cash flows of the future discounted to today, then how does it matter? Why do valuations even matter? So that's my question to both of you. Do valuations really matter? Slightly off topic, but just very brief on this. Kalpen, you first.
So I think all dimensions matter. The quality of the business matters, and then what price do you pay for it also does matter. If you significantly overpay, then the company has a very high onus to deliver, and the room for error goes down significantly. So that's one reason why paying a sensible price is very important, and not paying a crazy price. We have seen examples. I'll tell you 5 sectors and the market leader in each sector in the last 2 decades only, in our recent memories, in our investing memories. The first decade, we had Infosys growing at 40-50% profit growth for almost 8-9 years, and the stock gives 0 return. Because in the year 2000, it was valued at it almost became 100 times multiple. So, crazy valuations for the next 7, 8, 9 years, it gave no returns to the investor. Then somewhere around 2003, 4 or, around that time, take consumers. Hindustan Lever, the largest stock in that space, again for a long period of 7, 8 years, made no returns. Start from 2008 peak when capital goods became the hero of the market. Now, if you take engineering, L&T, for a long period of time gave no returns. Reliance for a long period of time gave no returns. So we have evidence that once, what happens is that when companies reach a certain stratospheric sort of valuations, we are expecting them to, score a 6 in every ball. And that may happen in 1 over, that 6 mein se 6 mein chakka maar liya. But there will be few overs when it will not be able to hit a 6. It will try to hit a 6 to maintain that run rate and lose its wicket. So what we are saying is that, it's always good to respect valuation, because ultimately it is a very core principle of investing. Also, let's not forget that right now we are justifying everything on, quality alone, because last 7, 8 years have been a very rare phase of discounting the future at very low run rates. The discounting machine is operating at 5%, 6% government of India bond yields, or global investors who are pumping in money in India, their discounting rates are very low. Now, let's assume a scenario that in the next 10 years somewhere, interest rates were to inflect. Someday they will, right? I don't know when. Now, when that starts happening, a lot of these narratives could change. So what we are saying that in my view, personally, when I do my investing, and I'm a very conservative investor because it's hard-earned money, I don't want to, speculate. I would rather go by margin of safety and not crazily overpay. Also, in very India, the Asian Paints are very few. The Nestles are very few. The Eicher Motors are very few. And when there is a lot of inflow coming in, lot of money chasing few stocks, these stocks can reach very high multiples. But there will be phases. Remember, like last 6 months, mutual funds have started seeing negative flows. अभी ठीक है वो हम FIIs ना के बचा लिया because बहुत पैसा डाल दिया. But if we were to have a trend of few years of negative flows, a lot of things could turn volatile. So, which is why I keep on saying that this is a fund, keeping in mind that when first principles will come back to rule, a fund like this will be very precious for investors.
Yeah. So, you brought this point at a fantastic time, Kalpen. This is exactly when we should be having this conversation, when the Nifty has hit an all-time high and not, whatever. Anyway, so Aparna, your thoughts?
Yeah, no. So I see. One is that the stocks may be very good, but the value is a combination of the earnings and the multiple, right? And it is very possible that the company is good. But the multiples, are exorbitant at 100 and 200 and whatever levels. So even if the company continues to deliver decent growth, it is possible that the stock price or whatever, which is reflected ultimately in the returns to the investor, will not go anywhere. And it will. So therefore, that degree margin of safety matters. And therefore, even if the stock is good, but you can't ignore the multiple or the what you're paying for it over and above that, because the stock will continue to be good. If you're paying so much today, then tomorrow when the markets are rallying, even if they rally, chances are that these stocks will not rally as much. Chances are that you'll end up underperforming, because you already paid for the future essential appreciation. So the stock may be good, the business may be good, the company may continue to be profitable, but you may not deliver or excess returns over the benchmark on that stock. And that is also part of our mandate, right? So it's important. And second is, while everything is future, but for us, essentially we look at the past to gauge the future, because the future is not coming from nothing, So, for example, when you're looking at historical growth, it gives you a broad sense of what you can expect in the future. When you're looking at historical valuations, again, those were growing companies only at that time. They commanded this valuation for that sort of growth. So you can't look at the future without referencing it to the past, and therefore you have to respect the past track records and the past data points also. And many times that they give you a better sense of things than forecasts, and we all know about the pitfalls of forecasting.
We just I just love the fact that we've covered so much ground. We've gone from talking about value traps to stuff that is priced to perfection. And you're right. I mean, Kalpen is also right. If you're going to pray for the entire future growth today, then what's left? So anyway, so last two questions. We're bringing this episode to a close. We covered how should our listeners look at this fund. Tell us from an asset allocation, both of you. From an asset allocation perspective, how should I position this in my portfolio? How would you look at this?
So Anupam, I'll tell you, this should be a very dominant part of an investor who again is a conservative investor and tends to get afraid with a very large intermittent volatility. Let's remember that every 4 or 5 years we see 20-30% drawdown in the market, and that is what unnerves a lot of investors who start by thinking that I'm here for the next 20 years. But typically money comes in at market peaks, and then in the next 2-3 years when volatility strikes, investors feel nervous and they tend to get out. So this is a fund which attempts to cushion volatility by doing two things. One, intrinsically buying good companies, so the business volatility is taken care of. Two, respecting valuations, so the valuation-led volatility also is taken care of. Three, by diversifying geographically. So there are times when Indian markets will be booming, but this fund will not go up. Let's say India goes up by 12%. This fund may go up by only 9% because one part of the global slice may not go up the same way. On the other hand, like we gave examples in our presentations that when Indian markets fell dramatically but global markets fell less, the fund will fall less. So this is a fund which has more cushion, and it's not a high beta product. So if you even observe the beta of the fund to the Nifty, it's lesser. The standard deviation of the fund to the Nifty, it's lesser. So it is a lower standard deviation, lower volatility product than the traditional equity product available to you. How is it minimizing volatility? By giving global diversification to one extent and by respecting valuations. So to an investor who wants to be a very long-term investor and who is willing to live through long periods of different performance from the rest of the crowd, from the rest of the equity products, including DSP funds or even the benchmark. So it needs that temperament to say, I'm fine with, markets are running faster, I am running slower. But when markets fall, this will also fall much lesser. So over a longer period of time, it should, aim to, earn similar to market returns, but with lesser volatility. So for such investors, this should be a very large part of the portfolio. For investors who come with a view that मेरा view है India में next 5 साल में बहुत तेजी है, पैसा बनने वाला है, then this is not the fund for that. And the reason for that, we have other funds. So we have our other products which are relevant because this is not a dedicated India product. This is a blend product. This is a product which will have some amount of cash in it when valuations are running up. So for aggressive investors, our other equity funds would be more relevant.
I just put out a poll today on Twitter that 15,000 will happen when 2021, 22.
You should have put out a month. You should have put out which month, not when.
58% said it'll happen next year, and I was like, "Hey, bhai, come on, yaar." Either say, where we were in 7,500.
But anyway, you never know. All these things,
I mean, come on. You've been through those cycles, where you.
But why not? Why not? Ho sakta hai na, temporarily ho sakta hai.
I don't know. Maybe it's this sheer negativity that has just been dominant in the last. I don't know. Forget it. Let me not go off topic. Aparna, just your thoughts on the positioning.
Yeah. So actually, we this would probably be a good for a first-time investor or a conservative investor. I would completely agree with the points which Kalpen has made. That it will be a good for a conservative investor or a long-term investor. It'll build in that margin of safety. It will smoothen the returns journey while giving good returns which represent the market returns at lower vol. But we would also say that this can be a good product for even an existing investor to consider, like to add a 10-15% allocation, because essentially most of the invest portfolios today, whether you look at the active or passive, are very polarized towards a similar set of stocks and sectors today. So a lot of our portfolios essentially are dominated by the similar type of companies, the similar type of risks. So by giving this as a complementary or a diversified offering, it helps. It will help to reduce the risk in an investor's portfolio of even having too much exposure to a very growth-oriented type of stocks. So even for a very savvy investor who already have sort of built portfolios, this could be a good option from a diversification or a complement sort of a portfolio, complementary offering to their portfolios. Otherwise, I completely agree, like what Kalpen said. It will be a good addition, but the temperament has to be right. So the investor's temperament also has to be aligned to the product, Otherwise, guys, it can create a lot of angst also.
Yeah. So, guys, please, usual disclaimer, as always, please consult a financial advisor before taking any decision. What Aparna said was absolutely on point. Depends on the temperament. Okay. Kalpen's made so many fantastic points on expectations and how markets have moved on in the past, for his sake, for my sake, for your sake. Oh, let's hope the Nifty hits 15,000. But let's also hope that things are slightly better than what they were on the ground. All of us have been through a lot. This recording is happening over Zoom. I don't know. I would love to be back in the studio. Anyway, guys, final question. The technique, all the fine prints, the details that you want that you want to give out, stuff like expense ratios. What date is the NFO open? How can you apply? Can you apply online? What do you do? Etc. etc. Let's just wrap up on that.
Okay, so we already started the launch, and I think the fund closes on 4th of December, and our minimum investment size is 500. Expenses for the regular plan are 1.6%, reasonably lesser than the traditional expense of 2.1, 2.2 that most equity funds have. And the direct plan expenses are at 0.8%. Which is roughly again around 30-40 basis points lesser than the traditional active funds, because this is a concept which is a combination of rules with some human oversight. But it is largely driven around rules, and hence we wanted to give that advantage in our expense. We want to be very fair in the way we price our products. One very important advice I always like to give. Today, a cousin of mine from Dubai sent me a portfolio of some 7 lakhs, which he had invested some 10-15 years back. And I would have advised him. But in 15 years, a lot of things have changed. So while he has made money, but a lot of his money was in the dividend option and, stuff like that. And some of those funds were not doing that well. And on that dividend, it's getting charged full distribution tax. So while it's very tempting to, come to my website and buy directly, I don't mind that. But if you really don't understand how to do product selection and how to see where it fits, please talk to a good distributor or a good advisor who can guide you very well. I am a manufacturer. DSP will, tell you how we manufacture the product, but whether it is suitable for you or not, to be very honest, I can never be able to tell you that, Anupam, this fits in your, portfolio, because I don't know your full portfolio. And you yourself are a very evolved investor. But a lot of listeners who may not yourselves, be able to put together your personal finance and portfolio construction, do not hesitate to talk to a distributor.
Thanks, Kalpen. I mean, you're calling me an evolved investor. I don't know what that means, because there's stuff that we learn each and every day. So thank you for that. Guys, this is advice that you do not get very easily. And like Kalpen said, from the manufacturer himself, please understand the product and how it aligns with your long-term objectives for your portfolio. I hope that I was clear in that. Aparna, closing thoughts from you? Anything that you want to put in out here?
No, I think for us also, we are investors in our own funds, Anupam.
Skin in the game.
Yeah, absolutely. So, we design our products trying to keep, investor interests very much at the forefront. So we very much hope that the investors in this and even in our other products will benefit And we are very we are very happy if we are able to add some value to the investors, and that's always our attempt. So yeah, that's all.
Thank you, guys. I mean, you guys are. I mean, it's just so refreshing to have such open and clear conversation with the mutual fund. From people like you who are taking all these questions upfront, because honestly, these are all the questions that I get from listeners, from friends, family. What should I do? And I really like what Kalpen said. So I wish you guys all the very best for your fund. Hope that you have a great launch. I mean, product really sounds interesting to me. And thank you so much. Thank you, Kalpen Parekh, President, DSP Mutual Fund, and Aparna Karnik, Head of Risk and Quantitative Analysis. Thank you so much for doing this for our listeners.
Thank you, Anupam. And all the best to all of you, to all the listeners. Thank you.
And listeners, if you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. If you want to reach out to me, I'm your host, P50 on Twitter. And thank you so much, guys, for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Remember the last vacation you took? What about the one you took 3 years ago? Okay, how much do you really remember? It's a question I've asked myself often over a decade of traveling the world. Hey, I'm Utsav and I do not travel the world for a living. I have a full-time job and responsibilities, but I have made traveling the world a priority. Priority enough that I negotiate extra leave in my job contracts, obsessively track my frequent flyer miles, and I'm willing to take off at the sight of a cheap ticket. Yes, I am cheap. I have lived and worked in 3 countries. I understand human behavior for a living. And these experiences have given me unique insights into places, people, and culture. With over a decade of travel behind me, I increasingly realized one thing, that we cannot see everything. So whatever we see, we must see deeply. Because as the film of memory decays, the imprints which will stand the test of time are the ones felt by the immersion of the senses, not by fleeting encounters with them. Postcards from Nowhere is an immersion into the world of slow travel, one story at a time. Tune in every Thursday on the IVM Podcasts app, website, or wherever you get your podcast from.
How aware do you think you are of your laws and rights? Do you look up to laws when you are caught up in situations? Do you know what your rights are when you're stuck somewhere bad? Well, here's a show that can help you move an inch closer to being aware of what your rights are. Tune into Know Your Qanoon with me, Amber Rana. This is a podcast meant to answer all your law-related queries. Catch Know Your Qanoon every week on the IVM website or the app or anywhere you get your podcast from.